Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's January 25th, 2019, episode number 12. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we're excited to have a good pal of mine join us on the Market Huddle. Tony Greer of TG Macro, and author of The Morning Navigator, Real Vision contributor, and just a terrific all-around guy, joins us to shoot the shit and have some fun. Tony, great to have you with us.
Oh, that's such a sweet introduction, Kev. You are the best. Thank you so much. I'm going to go ahead and crack the beer right now.
No. Wait. We're going to crack beers in a second here. Anyway, okay. This show is broadcast as both a podcast and on YouTube. So if you're enjoying this podcast and you feel like you're missing out on the charts and videos that we're referencing, you can register at the markethuddle.com website and get the weekly email, which includes our chart pack and video links, or just flip over to YouTube. In this week's episode, we discuss precious metals and Fed QT.
In our This Week in Trading History segment, we take you back to 1846, when on this day in California, the gold rush started.
And what's for our 1846 is 1848 or 49, wasn't it?
There you go. I already got it wrong. You can tell we've already cracked open the beers.
All right,
and for the WTF clip of the week, we have a frat party in Davos.
All right, and we're going to end with the 5 most important things to watch this week. So let's jump into it. So Kev, who's the sponsor for this week's show?
The sponsor for this week's show is Flying Monkeys, and it's the Optical Illusion, which I think is just a great beer considering what this market is doing these days. And unfortunately, we can't transport beer over the border, so we have to ask Tony, did you find your own sponsor, and what are you drinking today?
Yeah, I'm currently drinking one of my favorite craft beers, which is Coney Island Brewing Company's Mermaid Pilsner.
Ooh.
Yeah, absolutely. I'm a big fan of supporting local ones, and I've gone from being a totally against craft beer to being a total craft beer junkie.
Oh, nice.
Okay, well
let's crack these open and see what's going
on.
Cheers,
Tony. Cheers.
Cheers, guys. Thanks for having me.
Well, this is not bad, actually. This is half decent.
Tony, I'll just tell you that's an uptick from what usually Patrick says about our sponsors. Usually he sits there and he tells us how terrible it is.
Oh, but you know what? We've had some crazy sponsors though, dude.
That's
like
right.
It's not hard to improve upon.
I love that sponsor though. It's perfect for you guys.
Yeah.
Perfect.
Optical Illusion.
Optical Illusion.
Now, I have to do some legal stuff.
Do your disclaimer, buddy.
Okay, clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. Side effects of too much Market Huddle may include headache, nausea, vomiting, death, darkened soul, and or the condition known as hot dog fingers.
All right. Well, that's an important disclaimer for our listeners to have. Nonetheless, let's dive right into it here. Tony, you know what? We asked you to come on to the show, and we asked you to bring on a topic of something that you thought was happened in this past week that you wanted to talk about. What was the most important event of the week for you?
I tell you, Patrick, I think it happened today where the Fed officials, the journal article about the Fed officials cutting their balance sheet trimming earlier than expected. I feel like it's another leg to the S&P support mechanism that the Fed is clearly supporting. But I think what was interesting about today is that I'm a little bit of a U.S. Treasury bear right now. Yeah.
Oh my God.
Still thinking that there's going to be another big uptick in yields. And I thought I was going to get run over like a freight train today. With a comment that is sort of a next level of dovishness in support of the S&P. So when I hear that they are going to sort of, do less of the balance sheet trimming, which became a total wild card in the last several weeks, I found it interesting that yields actually rose on that day. So I'm interested in that. And, gold has been on my radar screen. I've been talking about it in my newsletter, and I've gone from, being bearish gold to being neutral gold shortly after I got taken out of that trade against Kevin versus Bitcoin, which was just, long overdue to get to flat.
Okay, why don't you let our listeners know what that bet was? Why don't you guys fill us in what happened?
Yeah.
Okay, Kev, give them the details, Kev.
Well, I think at the time you were a Bitcoin bull, and rightfully so, because I think it might have been, I don't know, Bitcoin might have been $10,000 or something, and you were saying that Bitcoin's going to the moon and gold is never going up again, and I said something like Bitcoin will get halved before gold gets halved, and you said, well, that's not really fair. And you're picking me off because Bitcoin is a lot more volatile, which I said, you're right. So we just
leveled it out.
Right. So we leveled it out. I think it was like gold, if it went down by like a quarter or maybe like 20% versus Bitcoin getting halved. Well, what happened was from there, you were absolutely correct. And Bitcoin proceeded to double. And, kudos to you because you rode that for a long way. And, but gold didn't go down in the meantime as much as you wanted it to. So the bet kind of just sat there. And then finally, Bitcoin gave in and it spiked downward. And I think it might have ticked within $100 of our bet a couple of times.
Yeah.
And it seemed like every time, it looked like I was finally going to be able to win. Someone went in and bought Bitcoin. I almost thought you were defending the quote or something.
It was timed like that too.
It was like a binary option. And then one day when I'd finally forgotten about it, I'd set a Bloomberg kind of alert for it. It finally kicked in and it went below and I won the bet.
Yep.
And I'm happy to say that what did we bet? We bet just like Duke and Duke. We bet $1.
Yep, exactly. And
we bet a beer. Actually, we bet one beer. So I owe you, or you owe me one beer. You're going to come up to Toronto sometime and get me the beer.
I'll PayPal that right over to you. So to go back to gold though, I mean, it's finally gotten interesting. It's finally, picked its head up above 1,300. My big level is, we can talk about it when we get to the chart.
Do you want me to flip the chart?
Yeah, sure. Yeah. Why not? Why don't we do that?
We got the gold chart.
Yeah, this is what's interesting to me about gold. And the green circle is that you've got this symphony of moving averages that are about to start curling up through each other, which, usually means that there's a bit left to the rally. You've got this.
Tony, that was so poetic.
Oh,
a symphony of moving averages.
Yeah, crossing up through each other. You know what I mean? Like what we say it like we used to say it like that. We used to call it that on the J. Aaron trading desk, where you can picture like all the CTAs, look at the moving averages crossing, and they're all going at the same time. It's that technical analysis being a self-fulfilling prophecy.
Yeah. Right.
At some level. So anyway, it's got that. It's got a breakout above last week's highs. We're going to go test it. Looks like this 1320 peak from June 2018, for the level that it absolutely passed out from, the red line, which I think is interesting. And then at least you've got to look now at the 13 3/4 level, which I think could happen quickly. Because quite honestly, I don't think there's too much standing in the way other than when I talk to some of the best gold traders that I know, they don't even really want to entertain my breakout beyond that price theory because they just think that, the higher up, the more mines are going to have to sell. And while I agree with that, it just might be met with a whole lot of central bank and speculative buying. So who knows?
So, Tony, I was speaking at the Vancouver Resource Investment Conference, and guys like Peter Schiff and stuff like that were there. Obviously, big push on gold, and everyone's obviously pushing this whole dollar gold narrative. So, okay, so let's go under your scenario here. Gold's heading back to the 2-year highs. We're heading up to that direction. Is that a dollar-driven move in your mind, or do you think that we're seeing a scenario where gold can kind of move on its own? And it doesn't need the dollar tailwind behind it?
I think the dollar always helps. The stronger euro is always going to create commodity buying. What's interesting this time is I feel like at least, I try to respect the fact. I respect the fact that gold is picking its head up against this socioeconomic background of, a mess in the Brexit procedure, a mess with the 10th week in yellow vests in Paris, a mess over here on the political landscape. A little bit of a mess on a central banking landscape where it looked like we were going to get a chance to raise rates again. It looks like they're going to go back to the same old song and dance of zero rates ad infinitum. And so you have to give gold, its credence, it's fair to respect it again.
Do you know, Tony, one of the things that I find interesting is that there seems to be very few gold bulls out there. Sure, like Patrick mentioned Peter Schiff, and by the way, Patrick, is he still talking to us after our WTF clip of the week?
You know what? I didn't mention it to him, but
No,
I don't think he's watched it. He hasn't picked up on the show yet.
Okay, well, let's just.
How do you even say there are so few gold bulls? I mean, I can point you to 50 gold bugs on Twitter.
No, but those guys are always bullish. So I look at those guys and I don't to me, the guys that are either perma bulls or perma bears, I ignore because it doesn't matter what
they don't shift.
They always say the same.
Right. Yeah, that's fair.
So to me, there's some very let's just take Eric, for example. I really like Eric and he thinks gold eventually goes higher, but I think he thinks it's headed lower over the short run. Same with Brent from Santiago Capital. He's ultimately a gold bull, but he also thinks that gold's headed lower over the short run. So to me, it seems like some of the kind of more flexible guys are actually leaning maybe not short, but long than they've been.
Kev, that's because their view generally is that dollar melt up is about to happen, right? So their view is that this is first a dollar story. Gold is going to get caught in that liquidity crunch, and then when the central banks kind of open up the floodgates, that's when gold will come to shine, right? And so it's just about them viewing it as cyclically as to where we are in that cycle and when gold will actually make its move. Tony, what do you think of that view? I mean, listen, tactically, there's room here for us to rally back up to the highs. There's no denying that. But are you really bigger picture bullish gold already? Like, are the major lows in, or do you still think that this is still a trade range? We could go up there and he just as easily come right back to the bottom end of the range in the next 6 months after that. Where do you stand on that kind of view?
Well, put it this way. I lean much less on a direct dollar view than you guys do, I guess, if that's fair.
Yeah.
You know what I mean? I don't really want to peg my gold view to what the dollar is doing because I feel like G7 has gotten even more difficult to trade in the years of monetization, if that's fair. And I know it's kind of an abstract idea, but if you gave me some time and 1,000 words, I could probably do a lot better job talking about it. But I think that my view is not necessarily dollar weakness dependent. And my thing is price action, so when this thing goes from sleeping below moving averages to not being able to break above a flat top to all of a sudden it's gotten up and moved and the price action's caught my eye and the behavior has changed in that it rallies in the New York time zone, which is bloody unheard of. I mean, there was a period of time there when you could have watched the gold price get tanked every morning at 7 o'clock before the opening. And you were like, what is all this gold selling coming from before the New York opens, And now all of a sudden the New York time zone, the thing has been able to pick up big moves, like today's 3%. Today's a 3 standard deviation rally, closed on a New York Friday. That's a big deal to me. And that's what I pay attention to much more than what this long-term dollar view is, right? So I'm attracted to this is the table that's getting high.
But you're tactically just trading a rally here for the next, let's say, month or more, targeting those previous highs. Is that fair?
Yes, it's fair. I think it's super vulnerable. But my thing, Patrick and Kevin, is I want to be low. I want to be, I've gone from as a trader from trying to be flat at the inflection points, like when we get back up to 1375 again, to now wanting to be limit long the next time we get up there.
Yeah. Can I interrupt for 1 second? It's Kevin here. Just to your point, Tony, about the gold not moving with the dollar. Today, it actually broke out in yen terms. It broke out in euro terms, and it also broke out in dollar terms. I completely agree with you. And I guess that's where I was going with my question is it seemed today that the strength was a little out of the blue and unexpected. And to me, it feels like it's a trade that nobody was expecting to work that's all of a sudden working.
I agree 100%, Kev. I'm sitting here writing my note about it this morning, and gold starts on this leg up through 1295, and I'm like, wait a minute, I didn't get this note out yet. You know what I mean? And my note was positive on gold, and the reason was that I just lifted a chart that just basically showed the size of the negative yielding sovereign pool of negative yielding securities. With Switzerland and Germany, about 60% of their float, and France with about, I guess, less than half of their float. And my case was that this is the bull case in gold, is that if bonds rally sharply, this negative pool increases massively. Say Germany goes negative out beyond 10 years again, that's going to be bullish for gold, just because, gold is going to be a cheaper cost to carry than paying, negative rates in sovereign yield. So that's my bull case.
Right. So you brought on another chart. Why don't we go to that chart and you can tell us what
Fibonacci's my favorite.
Yeah, right. Isn't it satisfying? So satisfying.
Yeah, so satisfying.
So
what's the story here?
Yeah, so this is the base metal, just call it the base metals index, the Bloomberg base metals index, right? It's copper, aluminum. I should get the weighting in front of me while I'm talking about it. But I look at this thing and my mind has changed 24 times in the last 6 weeks, right? So I wanted to be bearish when you look at the last half of 2018. I wanted to be bearish because it looked like it was curling over. But it never made any progress to the downside, right?
Yeah, no follow through.
Right, no follow through at all. Then it came off in the asset wipeout in the last quarter of last year, totally touched the Fibonacci level to make us all so happy. And now it's right back in the range again after we're pricing in the next level of economic weakness. You know what I mean? So like base metals have just rallied while, number one, we priced in this, starting with China slowdown, and then another leg of slowdown in this week's European PMIs and Japan PMI. So now we've got, a better case for the global slowdown on paper, and base metals are picking their head up. Meanwhile, iron ore has rallied 20% during this entire time. So this is like, these moves are like, waking me up at night because I don't understand them. And if you have viewers with answers, please get some for me and for us. So I look at this chart two ways.
But it's a bounce, Tony. Like, I mean, look, things were pretty oversold. Like, I feel that generally that December Christmas massacre kind of overshot. While commodities never got really caught in the downswing, all risk assets just got dumped.
Right.
And so when things turned around in that first week of January and things rolled over, I think all risk assets just got the bid, right? Like I think that this is all going higher. I don't think it's over personally. I'm not a buyer here, but you are. Are you going to give this a shot to the upside?
No. I'm trying to understand if, I want to be able to play it, right? Like this is where I'm comfortable. I'm comfortable in trades when the base metals are trending. Right. I cleaned up an XME on this base metal move in this index, call it from 140 to 160, and then wound up being able to be long, some base metal stocks from, this move from 175 to 200. So that's where I'm comfortable. That's like my equity trading wheelhouse. So I'm looking for that to line up again, but it won't line up. But that's all I'm saying. I'm literally looking to buy a vowel. I'm ready to go either way. And, the story of economic weakness leads you to believe it's going to curl over and dump to the lows the way that the economy just slowed down.
Yeah.
The global economy is always the market's always a forward-looking indicator. So by the time we get the news about it being at its worst, the prices will already be headed back up, don't you think?
It could be. And then that makes a nice case for this inverse head and shoulders if you want to take a huge step back, and say we had a shoulder on the 2013 low, a head at the 2015-16 low, and then now this is another shoulder forming whereby if this index trades above 220, you're talking about a multi-year low having been put in and the chance at, who knows, a commodity renaissance that I dream about.
So, Tony, I'll tell you something that worries me. You were mentioning that you stay up at night worrying about this index. One of the indexes that worries me is the industrial index. It's the CRB raw industrials. And these are things that don't trade as much meaning they're not speculated in with as much, and they're more stuff that actually is used in actual, manufacturing.
Mm-hmm.
And that index, I don't know if you can get it up there.
I'm looking at it right now. Yes, go ahead. CRBRIND.
That's correct, and it's hitting new lows.
Oh yeah, this is a good one.
And so for me, I look at this stuff that we're, the tradable stuff is going up, but the actual stuff used in their commodities used in manufacturing aren't going up yet. So to me, this might just be noise. And that's what I look at. It's just all you guys with your Fibonacci squiggles and stuff playing games with it. But the reality is that
tell us the reality, Kev.
Yeah,
tell us, because the last time
the fundamentals will eventually rule out, and it won't matter about which Fibonacci squiggle it hits.
Yeah, I know that you talk about these Fibonacci squibbles like they're nothing, and you said that I picked up on one of these squibbles in XDP when
squiggles with a G, G.
The squiggles, and home builders, and then they curled over 20%. My little
squiggles. Oh, so you know what, Tony? That's a good burn you just did, because Patrick's all over me about that, and you're absolutely right. I must say, Tony writes a great letter, and he was bearish on the home builders, and I phoned him up one day and said I'd read his letter, and I was like, "Boy, this is a terrible call, buddy." And he said, "Fine, sold to you." And they proceeded to dump, 20% lower. So you're absolutely right. And I have to give you credit. You are the master at riding the waves. And I think you're really great at that. It's one of the reasons we have you on the show. You're terrific at seeing those waves and riding them. And, all the power to you on the gold. You're sitting there going, it's going up. I got to be long. A trader's job is to be long. Like, don't look for reasons why it's going to go back down. It's going up. Somebody find it.
Yeah.
And I think that's something that I learn from you all the time. And I watch your trading, and I say, he gets in there and he goes and he changes his opinion. I kind of laughed. What did Dave Cullum say was your best line the other day from the Real Vision interview?
No, Rudy quoted me.
Oh, that's right. Ruby Havenstein, who's 161 years old, by the way.
I know that. I love him, though. I got a poster of him here in my office.
That's right. Well, why don't you repeat to everyone do you remember his line?
Yeah, well, what happened, he quoted my Real Vision interview with Brian Price, who I love. And Brian was, he and I were talking before the thing. And, I was pretty bullish the economy. Last time we had spoken, and Brian was asking me what I thought. And I said, well, there's been a lot of much weaker data, this and that. The picture's changed. And then we go right on to start recording. And he goes into a question. And he's like, now, correct me if I'm wrong, but your tune has changed a little here. Like he was trying to pin me down or something. And I said, my tune always changes. I'm a trader.
Yeah.
And that's the reality of it. You know what I mean?
Yeah. So I think, that's a great way to be, and it's hats off to you.
Thanks very much, man. You learn over the years that being less stubborn is a really free and easy way to live in the markets.
That's right. All right, guys, let's move on. I wanted to get to talking about what we thought was the most important thing this week, Kev. So why don't you give us a quick rundown on this?
Well, Tony kind of briefly mentioned it when he was talking about gold, and it was the article today in the Wall Street Journal that was floated by the Federal Reserve, basically setting up a trial balloon about winding down or at least being more flexible in terms of their quantitative tightening. And we can see there's the article. It was by Nick Tamaros. I don't know how to say that last name, but and it really was just that, a trial balloon by the Fed showing that they're willing to now go from, remember that famous or infamous comment that Powell made where the balance sheet is on autopilot, now being willing to go and actually contemplate changing it based upon economic conditions.
Right.
And to me, this makes the cave-a-thon by the Fed complete. I don't know,
the market reacted that way. There's no doubt about that. I mean, the moment
this is let's just stop and think about what Powell has done. So October 3rd, we are a long way from neutral. Market tanks. He sits there seemingly kind of oblivious, sending signals that we're still a long way from neutral, till it gets to the point where Trump's screaming so loud and Warsh and Druckenmiller are making comments. And then, he sends in and he completely folds. and he folds on the interest rates.
Yeah.
But he makes the mistake of not folding on the balance sheet. And that causes a little bit of waffling in the market and some problems again. And so what does he do now? He's folding on the balance sheet.
Yeah.
And it's just, I've always argued that in the long run, the central bankers are going to do everything they can to print. And we kind of thought for a little while that maybe Powell was different. Maybe he was more worried about a financial markets bubble than he was about he didn't want to be mopping up kind of another 2008. But it seems obvious to me that he's no different now than Bernanke, Yellen, or even Greenspan.
But okay, realistically, the Fed is like that largely because of the nature of our monetary system. I mean, I don't think there was much choice if you really look at it from the bigger picture. I mean, they were just raising interest rates to see how far they can go before the economy was responding. They're always taking the cue from the market. The market is basically, when you go to those Eurodollar futures markets and look at the spreads, they're already rolling this over. They're already saying that they're going to be cutting within a year, right? And so to me, this was just the Fed seeing how far they can go before they were going to have to turn. It's like it's a monetary cycle that plays out.
Well, but then why was Powell giving us all these big, long speeches about, Main Street versus Wall Street and the monetary conditions versus financial conditions? And he was sending all sorts of signals that said that he was going to be different than the other guys.
Yeah. Can I share a signal?
Yeah, sure. Jump in, Tony.
I was amazed that when asked in an interview, I forget which one it is, I think it was around Jan 10th, and they started asking him about the balance sheet. And it was a gal who was interviewing him, and his response was, well, it will be a lot smaller than it is now. And the girl interviewing him says, what is it now? And he says, it's a little under 4 trillion, but it was a trillion before the crisis. Oh yeah, there it is. But it was a trillion before the crisis. And then she said, well, what do you think, what are your plans for it, essentially? And his answer was, it will be smaller than it is now, but nowhere near where it was before. And that was his quote. And I was like that was like someone smacked me in the side of the head. And I was like, that's an unacceptable answer coming from an unelected government official that is in charge of a $4 trillion pad.
What you're saying, he should have been telling them where it was going to end up?
If you ask me, that's not an acceptable, that's a vague answer. If a student gives that answer to a test, he gets an F. But because he's the Fed chairman, because he's the Fed chairman, he's allowed to say nothing. You're supposed to be the guy guiding markets. How about telling us this? It's going to go to 0 or 1 trillion again, or telling us we're going to cut it to 3.5 T by the end of the year, or we're going to have it down to 3 trillion in 5 years, or start giving us some guidance on it. We have to get guidance on it.
Tony, am I wrong to say that the Fed balance sheet is basically base money? It's the monetary base that's functioning within the economy. And we had Russell Napier on Macro Voices just this past week, and he referenced money supply quite extensively in there, and he was talking about the fact that this money supply has actually been contracting, and this is what's causing the global slowdown. I think generally central banks know that they can't shrink these balance sheets because they're shrinking the monetary base, which is preventing there from being any growth in money supply, which is going to cause the whole thing to become a shitstorm. Yeah. So I think that generally they know that they're going to try to contract it, but they know they can't go back to 1 trillion. I think he just didn't want to admit that they're not going to be able to remotely cut as much as everyone thinks they will be.
Right. I mean, my point was that he should have even given a full answer, or at some point he would have to be honest, but that to me, that answer stunk. Right. Yeah. That was that was unacceptable. That answer got an F.
Sure. Yeah. I'll give it. He's been all over the map lately, and that's my big complaint. That's what I'm most disappointed in him.
Is it all over the map, or is it just the transition from him going from hawkish to dovish? Is it like, I mean, okay, if he turns around and in the 3 months from now is hawkish again, then I will give you guys the thing that's all over the map. But what if this is just the transition? What if this was that October was the hawk moment, and we are now in the dove moment, and then it's just at this point, if he doesn't flip-flop from here, then we just witnessed the head and shoulders on Fed policy.
Okay, so Patrick, if that's the case, he was too slow in doing it.
Yeah.
Because the 24th, like the Christmas Eve massacre, he was still really, really hawkish at that point and he had a couple of chances I can't remember the exact dates, but he had a couple of chances to kind of signal to the market.
Should the stock market be the mandate of the Fed?
It is. Yes, it is.
Well, okay, it might be, but the reality is that he caused way more, like he was overly hawkish. Like when was the autopilot comment? Tony, I like it. You're.
Oh, is that another beer?
Yeah, no, yeah, I am.
Oh my God, I'm gonna have to run to the fridge and grab another one of these.
Please, Kevin, I'm gonna be looking at your notes on Jerome Powell to figure out what's going on here.
But I really thought that he was, he either should have panicked earlier or not panicked. And that's kind of how I feel about him. I'm disappointed, why all that extra, like, the balance sheet is on autopilot, when he was pushing back against Trump and stuff like that. If you're going to fold early. Like, what's the point of waiting this long to fold? And now when the thing's screaming, he's going to be turning around tomorrow. And I'm convinced that he's worried about a financial, markets bubble. And I'm convinced that if this continues, like we're up another, 1% today and stuff is screaming, if it does continue, and I'm not sure that it is going to continue, but let's say it does, I'm convinced that he's going to be turning hawkish in no time flat.
You know what I feel like we're doing? I feel like we're a sports commentator group here of three guys. And we're dissecting all the plays that they should have done in the middle of the game. But they were on the field and they were playing the fucking game real time. And we're here going in retrospect saying, well, they could have, should have, or maybe could have.
Okay. But Patrick, 1 second. Let me
you go first and then I go.
Okay. So if you go read the minutes for the December meeting.
Right.
And now there's some debate about whether they are presenting them in a dovish light or not. But why did they hike if what they were talking about was truly the case? It's almost like they hiked as a big FU to Trump.
Wow,
no, really, honestly.
No, you know what? I'm not going to dispute that.
And not only that, like, I think that Stanley Druckenmiller said something correct when he said, when they asked him about, well, would it be bad for the Fed to, not hike because you guys or Trump are influencing them? And he said, yeah, but what would be equally bad is for them to hike because we're saying something.
Yeah.
And I really feel that now we're all forgetting that they had lots of chances to ease up and they eased up at the wrong time. So I'm confused as to why they were so hawkish, at the December meeting. And then in the December kind of press conference where he was like, it's on autopilot or whatever, he was super hawkish and then had a couple of chances to fix it and he didn't fix it. And then all of a sudden the market falls out and now all of a sudden he's turning around and he's super dovish. It makes him look, I think he's undermined the Fed's credibility, not helped it. Because to me, not enough has changed in the economy. All that's changed is in the markets.
Tony, you want to pile in on that?
I would like to pile in a little bit. What it seemed to me was that, like Kevin, I got the total vibe that Powell was different this time. I accepted that vibe because everything has been different this time, from, President Trump to Brexit to all kinds of things that are going along with the end of globalism. So I was taking Powell at his word, and then it was clear to me that he didn't get some sort of memo that Steve Mnuchin got. Like, all of a sudden, Steve Mnuchin was like, wait a minute, this isn't being handled the way that I'm told that we can handle this. And he got on his Twitter machine and sent out his call to the President's Working Group banks, which he made widely publicized, And that was him trying to set the rally on fire by putting out the storm. So that's why I agree with you that, that if it was a legit job done by a legit group of leaders, it should have been done way earlier, that they were going to consider, hey, listen, if we see stress in the financial markets, this whole deal is off. That was never even a consideration when they got started. So I agree with you that they got to make the adjustments on the field, but they could be telling us, hey, look, if the financial markets can't handle this, we're going to knock it off. But they went into it saying, yeah, we're going to do this. And, we're not really that concerned with the ramifications, was actually, I think, a comment Ben Bernanke said, that he didn't think it would pose a risk at all to the bond market.
Right.
So but that's all I wanted to say.
Yeah, no, but you know what? That's definitely, you're bang on. I mean, that's definitely some perspective. Now, let's move on though here, Kev, because you got Barton on that Twitter feed to send you a couple charts here. And
that's right.
Why don't you share with us quickly what's going on here?
Sure. I was trying to understand the whole idea about the Fed balance sheet, and there's a lot of debate about whether they're behind or ahead in terms of the amount that they're due to wind down. So I reached out to Barton_options on Twitter. He's just a great follow. And if you're at all interested in the kind of, I guess, liquidity injections or withdrawals that are happening because of the different Fed, I guess they're permanent open market operations, you should definitely follow this Barton fellow. He's just awesome. And so what we came down to was, these are the actual what they call the SOMA, which I guess I don't even know what that stands for, but it's basically the balance sheet of the Federal Reserve and how big it is. And one of the kind of disputes is whether they're behind the curve in terms of how much the Fed is already withdrawn from the market and like wound down their
how much the tapers actually, or the
that's right, the taper,
the tightening or tapers actually happening.
So what it came down to was, he explained it, and we ended up figuring it out, is that the Fed said that they were going to have a $50 million or $50 billion a month ceiling, and it's important to say that's a ceiling, not a minimum.
That was huge when you sent me that stuff, and that was the key takeaway from that, isn't it? Because it's not 50 billion a month.
It's 50 billion a maximum that they're going to wind it down.
Right.
So it all depends on when things are coming due. And you can see on that second chart, which is the amount of the actual redemptions, that they have been kind of not hitting up against their $50 billion like a month limit. But the thing is, they never promised that they were going to do 50 billion a month. They promised they would do no more than 50 billion a month. So the interesting takeaway that I got from this is that the Fed is already…
So just to be clear for our listeners, there's 30 billion in Treasury and 20 billion in mortgage back. So when we're looking at these two charts between the two, that's 50 billion combined.
Right. And so the key to understanding this is to think about it as that they promised that they're going to do no more than 50 billion a month in terms of winding down their balance sheet.
Right.
But
they've been well under that.
That's right.
The tightening is not remotely as big as a lot of people are advertising.
That's right. It's already falling short of expectations. So the Fed is already
from what I see here. Am I fair to say that the average tightening in a month is probably more in the $20 to $30 trillion is what I'm taking away from here?
Right. And in terms of it, it's just the important thing to note is that second chart to see where they could be versus where they actually are.
The second chart is actually just MBS.
That's right. Okay.
Right. So that's just how much they're falling short on mortgage-backed securities. So we have to combine the two together to get the idea of what their combined shrinkage is.
And they're falling short, and that's the end result. And so they're already easing up on the brake, was what I read from this.
Well, yeah, and that's for sure, because where was it? There was like a tweet out there, something like this month they're only like at 18 billion or something like that. I don't know how accurate that number was, but they're nowhere near 50. They're nowhere near 50 billion.
Right, and it's complicated because the problem is that they don't sell bonds. So remember when they were doing quantitative easing, which meant that they were actually buying bonds? They were going out and they would have a schedule, and they would say, we're going to buy 4 billion today. We're going to buy 6 billion on Wednesday. We're going to buy 3 billion on that. And they would do it. The trouble is now they have all these bonds that are maturing at various times.
And they're just letting them mature.
That's right. And trying to kind of within that, manage this and still wind it down by that kind of projected amount. But all of a sudden, they're not doing as much as they kind of led everyone to believe they were going to do, or at the very least, the amount that they said they would do no more of. So the real question was, when they gave us that number, was that a target or a ceiling? And it seems to imply that it's a ceiling and that they've already eased up on the amount that they're going to redeem. And maybe this is part of the reasons that we're already.
But tightening is tightening, right, Tony? They're not. They're definitely not buying.
Tightening is tightening. I'm with you.
Yeah, there's definitely a shrinking of the balance sheet here.
Yeah,
but does it come to an end, Tony? Does it? Is this Wall Street Journal article the turn point? Are we, let's say, 6 months from now, going to be talking about that this was that moment where we reached that kind of crescendo moment where the whole thing just shifts?
It could be. It could be. It feels like everything had changed. And so, like I'm just going with you guys and saying that tightening is tightening, and that's what the Fed is responding to. And so it's going to be totally, it's not data dependent. It's S&P close dependent.
Right.
You know what? Tony's absolutely correct.
That's what it's dependent on.
The S&P keeps going up, then they're going to go and they're not going to ease up on the quantitative easing.
Right.
And
right.
If it goes down, they're going to ease up on it.
Right. And if
it's kind of sad.
It is. And if it breaks through 3K and the Chinese go back about their jobs and buy enough iPhones, then we won't have anything to worry about here in the U.S. Because, if you ask me, that was part of the narrative underneath the narrative, that when Powell started saying that the markets were sending signals, it's like, the signals that you're talking about are FANG getting utterly stomped on for a few technical good reasons on top of this whole discussion about what the Fed is doing. So I don't know, it all plays into a scenario to me where we're carving a top that's going to be difficult to recuperate. That's all.
Yeah. And Patrick, I'm going to weigh in on the last word here. I'm going to say that this was nothing more than a trial balloon, and they might tweak it a little, but the reality is they're going to go back to reducing their balance sheet, and that we're going to be disappointed with the amount of change that Powell does, because in his heart of hearts, Powell does not want to see another financial market bubble, and I think that it won't take long before he's worried that he's eased up on the brake too much.
I'll take the other side of that. I'm not going to agree with you, but anyway, let's leave it at that. That's what makes the market. All right, boys, let's move on.
So, Tony, what do you got for us for tales from the trading desk?
All right. Well, I'll try to tell a tale. I'm a big open outcry guy, and without having, I hate to have a story that doesn't have, a big philosophical beginning or ending kind of thing, but I would talk about my experiences on the floor of the New York Mercantile Exchange, or rather than the COMEX, with, as a gold trader with Goldman Sachs, right? So I'll tell you about one day, I was literally a pretty new guy down there, but I had gone down there to manage our sort of gold options and our gold cash position directly. And a day came where we had a massive ARB position on, which means that we had we were long physical metal. We were long the floor and short physical metal and gold.
So 1 second. When you say long the floor, you mean long futures?
Yeah, exactly. So we're long futures and we are short physical metal, but futures are rallying, and the exchange for physical. The EFP is blowing out our way. We're really properly positioned for this.
Of course you are, because you're Goldman Sachs.
Exactly. So what happens is, to make a long story short, I'm talking to, the head trader on the desk, who's a dear friend of mine still, Chris Carrera. And we're talking about unwinding as much of this position as we can that day going into the market. We know there's going to be futures buying, et cetera, et cetera. And it turns out that our illustrious broker, nicknamed and badge named Ski, is not going to make it in that day. He's got a death in the family, and Ski literally hasn't missed a day of futures trading in his entire career. He's the most revered guy in the gold ring. And now the young guy with badge TGNY has to step in and trade a total of 30,000 gold futures as it wound up that day. As basically there was a flood of fund buying. I had to be the seller. And I basically got christened as a futures trader that day, from being, an options trader and a guy that was just down there to sort of make sure that our positions were looking after properly. So now I get thrown in the ring that day, and I've got guys ripping my arms off from bell to bell. Literally. And I've got EDF Man trying to buy 4,000 contracts, of which I am like 2,000 contracts of the selling, and the orders just keep coming from the gold trader over the phone. And from my broker to me to the ring, you can imagine the game of telephone that was being played. And, we felt like we were messing things up, and then we're getting caught up again. But the moral of the story was I managed to maintain my focus and keep things going the entire day. I didn't get a single break for an entire day. But what was amazing was the floor community was totally in support of me. Right? There was nobody out there. There were guys that had big orders, and there was nobody out there that was trying to run me over or kill me. And I thought that was a real credit to the community down there, and told a really great story about the type of people that were down there, because they were down there making their living and getting orders over the phone, looking to execute as buyers for funds. And I'm the only seller in the ring, and there's nobody around. This thing is taking off. Gold's going $2 at a clip. And I'm getting orders to sell 1,000 lots, $1 scale up above the market. You know what I mean? And I can barely keep up what's going on in the real time. You've got to check everything. Has got to be cross-checked with the badge you traded with and the time on the clock. And let me tell you how difficult that is. I think I had like 3,000 trade entries that day.
Wow.
Yeah, so it was literally like the hairiest day of trading of my entire life. I bought 4 contracts and sold 30,360.
So now let me just understand this correct. So you were actually a member. So you had like an actual badge, which is like different than the clerks.
Yep.
And
I'm
a lot of
cracking
times,
a beer. Go ahead.
Yeah. So just so everyone understands that the clerks, the guys, I don't know. I was at the Merc. So the Merc guys had yellow jackets. I don't know what the clerks at the Comex had, and they aren't allowed to trade. But only the members are allowed to trade.
Yes.
And so the trades, like sometimes the members would sit on the phone and then basically use a jitney or use a broker in the pit. But on this day, you had to go into the actual pit. Is that correct?
Yes, that's exactly what happened.
Right.
And replace a guy that is literally the Zeus of the Comex.
So basically, you're like Eddie Murphy and Dan Aykroyd sitting there, like putting your tongue to your finger and like handing out tickets in terms of you're the only guy selling.
Yes. So here's the best story is, as the bell is about to ring, gold is getting bid up, and there's no Goldman Sachs broker in the ring. Right. And so now I've been on the phone with my boss upstairs for probably 20 minutes straight. Before the 8:20 gold bell rings. And all of a sudden I'm like, okay, I've got my pad, and I walk into the ring right in Ski's place, which is badges, on the top row with all the big guys, meaning physically big, because on the floor of the Comex, the top row, they're like 6'2" and bigger.
Right. Well, let me just explain that for a second. For those that, are just used to computerized trading.
Yeah.
In the old days in the pit, where you stood was really important. And guys would like get there and there would be fights about where you stood, right?
Oh,
like,
yeah.
You had your spot. It's like kind of like your parking spot out in front of your house. Like when someone parks in it, it's like, what are you doing? You asshole, you're in my spot.
Oh,
and what you wanted to be was, you think that the middle would be the best, but it's not, because the middle, you can't see the action. And what you want to do is actually be on the end, like at the top, because that's where you would all get the orders from the kind of the desk. Is that correct?
Yes, exactly, Kev. There's 2 ways to look at it from the top step. Is you are number one, the steps literally go down into the center of the ring. So as you go deeper into the middle, you go lower. So the benefit of being a top step guy, as it was literally called, was number one, you could all the brokers were always in front of you. Number two, you would have a beeline at least your clerk who was right behind you. And there were guys that had, literally there were second or third step brokers that had clerks outside the ring that had a hand order tickets between guys' legs. Right at that point, so the top step was everything. And then you'd have a beeline to some competing broker's phone clerk and be able to see the orders coming in on the other line and get that information back to your desk.
Isn't that crazy? Like you could actually see the orders getting signed in.
Yep.
And you could actually, so listen, I have a question for you. Like there was a standard signing that everyone used. Did you guys have a secret one? Like that you would like the special Goldman Sachs signing so nobody could tell?
No, there was no special signing or anything like that.
There was no special signing. Everyone used the standard one.
No, I had the one thing that I wanted to share was I got to that morning as we got to the opening, the whole world is looking for our gold broker. And I step in there literally with, my badge visible and a fresh pen and a stack of trading sheets in my jacket. And I will never forget, the broker next to me is a guy named Angelo, and he turns to me and he goes, yeah, hey, good morning, Tone. Where the F is ski? Right? Like things were definitely heating up. You know what I mean? He knew it was going to go berserk. And all of a sudden there's a guy in there that like I stood in for ski before, like when he goes to lunch, like not when gold is gapping higher $5 and the things, we're about to sell every contract that trades that day in the open interest. You know what I mean? So it was a little bit hairy, but it was amazing, amazing experience that I'll never forget.
That's a great story. I have one question for you when I'm just trying to understand this. So you're long futures. How are you short the physical? Like you promise the physical to somebody in the future? Like how does that work? I don't really understand.
There's a very robust physical gold market, Kev, that's quoted, cash gold is quoted just like futures are quoted. Right. So when you were, when I ran the gold book at Goldman Sachs for Jay Aaron, and, part of my book was physical risk and the other part of my book was exchange risk. And the other
you could trade gold short and like borrow it overnight.
Well, yeah, exactly.
Yeah.
And I mean, you know how easy that is to do. I mean, there's like 12 claims for every ounce of gold out there. You know what I mean? So it's very easy to borrow gold. People are anxious to lend gold. The lease rates are close to dollar rates. So
I get it.
Very easy to calculate the cost of carry, et cetera, et cetera. And, you would get the game was we were the biggest ARB book in town, so physical against the board always had a price. And we were the biggest book in town. And so we were literally as big a part of the open interest as we could be within legal limits. And that was something we monitored very closely and never, crossed over the line. But we had serious positions that way of the board against our physical position. And the best part was that, gold would be breaking out and we would be completely long futures and short physical. And people would see us selling gold scale up at every price. And, that's all that they would talk about. You know what I mean? And it was just fun to know both sides of the picture and walk around the exchange and hearing guys say, oh, well, the big seller is Jay Aaron. I mean, they're a seller at every price. Meanwhile, we're long as much gold. We're long the queen's ransom of gold. You know what I mean? Physical price. And all they see us is selling futures. So you get a great reputation for being a seller and you walk around with a smile on your face.
That's great. That's a great story.
Sneaky.
Thanks for sharing that with us.
Very sneaky.
Anytime.
All right. So, Tony, you write a newsletter. Listen, for all of our listeners that are interested, they can get a free trial. Why don't you give us
1 second
rundown?
before you go on about that? I got to share something about Tony's newsletter that just makes me laugh so hard.
I read it all the time.
And Tony has a way of, like with my newsletter, I try to have a funny picture and that's what I do. But Tony actually uses words to be funny. And he has this great section at the end where he has these great quotes that he kind of puts together. And I must say, like every single day I open it up and I'm always like, I'm looking forward in anticipation with the different quotes that he finds. Lord knows how you find these.
You're the best.
There was the one the other day that just made me laugh so hard. I thought I'd share it with everyone.
Right.
And it was, I don't know what your theme was. I can't remember exactly, but you had a Rod Stewart quote and I'm going to just read it. Cause it just like, he says, instead of just getting married again, I'm going to find a woman I don't like and just give her a house. I was just like, when I saw that line, I just thought, I don't even care what you say about the markets. That thing made me laugh so hard that I was like, that was worth it just for there. So I love getting your letter. I'm being a subscriber for a while. It's a terrific product. Tony, why don't you tell us about it and how clients or listeners can get it and sign up for it?
Yeah, man, I do it really simply. I'm at www.tgmacro.com. T as in Tony, G as in Greer, Macro, MACRO. You can go and sign up right on the homepage. I've got a sign up for a sprint trial, which will log you onto my distribution list for 2 weeks and no longer than that. I keep my promise with everybody, and I take them off the blast list after 2 weeks and ask them if they want to sign up. And I'm very fair about it. And that's how I've developed a great rapport with my clients. And I found that I've got a great retention with the people that do sign up. And I feel like that's because I try to manage everybody that signs up, not as a subscriber per se, but as a client, and be interested in why they're interested in markets and why I'm helping them. And that's been really fulfilling to learn about all the different people in different places I've been able to help. And I think that's made my product better, if that's fair to say, from responding through it to client questions and client themes and the things that I'm feeling. I try to sort out and then present to other people. And I feel like that's why I've gotten a little bit of traction lately. So you can go to tgmacro.com and sign up for a trial. You can read some of the samples and testimonials that are there. And that's the end of my sales pitch.
Well, there we go. Tony Greer, the nicest guy to come from Goldman Sachs.
God, you're the sweetest.
Thanks
for coming on,
Tony, for coming on the show.
It was a pleasure. You guys are so much fun. You made my Friday afternoon. I'm really in a great mood for the weekend now. Thank you so much.
Cheers, Tony.
You're the best.
Kev, let's move on, though, to this week in trading history. So what do we have in store?
Well, you know, in this day in 1848, prospector James W. Marshall struck gold in Coloma, California, and the Great California Gold Rush began. And you know what I found most interesting about this story is that I had no idea why the San Francisco 49ers were called the 49ers.
You know what? This was the most amazing episode because I learned some important piece of history today.
Yeah. Gold fever started in California when this guy claimed he simply bent down and scooped up a dozen gold nuggets from a stream at John Suter's sawmill.
Right.
Okay. And unfortunately so what happened was that was in 48, but the news didn't reach the East Coast for a while. And so that was in...
it took like 6 to 9 months because they didn't have internet back then.
That's right. There was no internet. So once word, hit that there was this gold rush and it was literally just like in the streams to be picked up, everyone from the East Coast, went over to California to go make.
And that was that. They made how many cowboy movies and cowboys and Indian movies of that movement of the people, but the 1849 was huge. Like that was. Right. That was when the continent of North America moved from east to west, and it became one full continent, right?
Well, everyone rushed over there, and by the time they got there in 49, like the boom was it was in full swing, but they had missed the best parts of it, and so that is where the word,
free gold.
The San Francisco 49ers is basically about all that rush of people that came in 1849 after they heard about the 1848 kind of California gold strike.
Yeah.
And I had no idea.
You know what? You just have to watch some TV shows like the Gold Rush shows that they still do this. They pan for gold. This hasn't gone away even almost 200 years later.
Well, you know what? I could just picture you, me, and Tony out there panning for gold.
We do that every day in the markets.
That's right.
All right, let's move on. Kev, time for what is becoming a fan favorite, the WTF clip of the week. What do we have in store for our listeners?
Well, Patrick, when we saw that there was Davos, this was the week for Davos for all the guys to head up all
Both of us were combing the Davos meetings for a video clip, right?
We knew we had to do a Davos one. And, there was lots to choose from. And I was really trying to find somebody that said something really just kind of, eye rolling, and that I would make something that, you know.
You were waiting for Bono.
Well, that's right. Bono was speaking, and I almost made a Bono one, but then, you know, there was this comment about the frat party, and I just couldn't resist. So here we go. Without
CEO came on because he in the past made anyway. The clip explains it all. Let's watch.
Last year, when we were talking about the economic cycle, you talked about thinking about it a little bit like a party.
Excuse me. Pardon me. I just want to get through there, this door over here, if you don't mind. Thank you. Thank you.
Oh, this is his house. Yo, what's up, man? How you doing?
Oh, no. That's my friend Mitch.
I think it was a bit after midnight is where you put it last year. Where are we now?
You're mistaking me. That's my friend Mitch. He owns the house.
Oh, okay.
Yeah.
Anyway, yo, man, come hit this right here. You need to hit this. Oh, yeah. Hit that.
No, I appreciate it, but I told my wife I wouldn't drink tonight. Besides, I got a big day tomorrow. But you guys have a great time.
You know, I was trying to explain this to my kids, and I said last year that the economy was like a fraternity party. It was 2 a.m. It had been going well. Monetary policy had been driving it, and suddenly someone came in with a new keg.
A big day. You doing what?
Well, actually, pretty nice little Saturday. We're gonna go to Home Depot. Yeah, buy some wallpaper, maybe get some flooring, stuff like that. Maybe Bed Bath & Beyond. I don't know. I don't know if we'll have enough time.
You
know what? Give me that thing. I'll do one.
We gonna do one. Do you, baby?
Called fiscal policy. It's now a little closer to 4. Late in a party, people start doing strange things.
Oh! That's a talented man. That's what I'm talking.
Do it up again. We got it. So good. Once it hits your lips, it's so good.
Volatility in the marketplace, chaos in Washington. Doesn't necessarily mean you leave the party, but it certainly moderates your behavior.
It means the sun.
We're going streaky! Yes! No, I'm sorry. We're going streaking through the quad and into the gymnasium. Come on, everybody!
Sun's coming up soon.
Yeah.
Soon. I was going
And
to
you're going to do the walk of shame if you're not at it.
As an investor, you don't want to do the walk of shame.
Bring your green hat. Let's go. Come on, everybody. We're going. Here we go.
Man, put the music back on. Let's get the party back cracking up in there, man.
Woo! Come on. We're streaking. Come on. We're running. Come on. Woo! We're streaking.
Play that out. I mean, is that a stretch to say the party's very near the end and you don't want to get caught in this, or you think there's still opportunity that's out?
Wait a second. Is that guy? Oh my God.
Oh my God, that's disgusting.
Why am I looking at that?
Wait, why are you slowing down? Just drive.
Stop. Frank?
There's 2 things that are clear to me. First of all, absolutely, we're a day closer to the end than we were yesterday. But secondly, while the numbers are not necessarily bad when I look at them day to day, I'm seeing the seeds of the cracks being planted.
No way.
Frank!
Hey, honey. Hey,
What the hell are you doing?
we're streaking. We're going up through the quad to the gymnasium.
Who's streaking?
There's more coming.
Frank, get in the car.
Everybody's doing it.
Now.
It's it.
I was when you did this clip, I was originally gonna tell you to grab scenes out of Project X, but I have to say something special
About Old School.
About Old School.
It's a great movie. It's terrific. I just want to say one thing about this Davos. You know, it's just there's so much information. Like there's so many easy targets there. I have a picture here of a day in the life of a refugee that they actually have. You dropped off in a town car and you get to go and do this after you had your $50 Cobb salad or whatever it is. I see that 1,500 private jets have landed in Davos, and they're the kind of the organizer of the World Economic Forum is encouraging everyone to try to share a private jet when they're getting there, because they get there and they, lecture us about climate change. Meanwhile, they're showing up in their jets. It's just, I don't know. It's like, it's beyond words at times. And I'm just shocked at this thing. This thing's almost an embarrassment, and they should stop doing it. That's kind of how I feel about it.
But let's go back to the economic cycle, because it's 4 a.m. or is it 2 a.m. or 4 a.m.?
No, it's 4 a.m. now.
4 a.m.
And Will Ferrell is streaking down the street all alone.
Did Powell just right now bring in another keg? Because the stock market's behaving like someone brought in a new keg.
Yeah, no, he not only brought in a new keg, he brought in like cannabis infused, like special energy drink. Like it's crazy that he's doing this. And I think it's nuts, but so be it. What do I know? What did the Chuck Prince say? You have to party when the dance is there. And I think we're getting closer. And one of the things I will say is that you have to remember that in a bull market, often the last 50% of the price move is in the last 10% of time.
Right.
So although I am nervous about this kind of rolling over, I'm also cognizant of the fact that we could have a situation where it just extinguishes itself in one huge final blow-off party with Snoop Dogg.
But you think that that's in the equity markets? I think it could be in the dollar.
Could be wherever. I don't know.
There's going to be a party. One way or another, there's going to be a party. We just have to find it. We are going to be walking down the streets, and we're going to be looking for the party. Is it in the dollar? Is it in gold? Is it in the stock markets? We'll find the party.
Yeah. Well, not only that, I'll be an idiot, and I'll be the other way. I'll be shorted and try and telling everyone it's not a very good party.
It's a shit party. All right. Let's move on. All right, Kev. Top 5 things to watch next week. But before we get to the top 5 next week, let's have a quick review of the top 5 things we talked about last week, and let's review them. So number 5 obviously was just a holiday, but number 4 we were talking about the Tesla level. Now Tesla did not hold 300, did it?
You know what? You're the one with the squiggles, so let's have a look here. Let's pull it up and.
Oh, here I'll pull it up. So it did break. But obviously with the stock market getting a little bit of a rally, it's trying to get back above 300, but we are below 300 here. I still am quite bearish Tesla. And you know what? But there's one thing that's going to decide this, isn't it? It's the Tesla earnings coming up next week.
Yeah, that's a big deal. I did see that Elon's mom was tweeting out about the short sellers, and I'm not kidding. Like, that's not a joke. Like, I'm not kidding. Like seriously, you're laughing.
That's serious ammunition. You're bringing mom out into the Twitter universe.
Like, you know what? Like, that is serious. I think when we look back, and there's always a poster child for every excess like that we have, and whether it be Enron or whether it be the Cisco or whatever it is, or WorldCom for the 2001. There's always something. And I'm really becoming convinced that there's a chance that we look back and we say Elon and this Tesla stuff was just the poster child of the easy money that we've experienced.
Oh, yeah. You know what? I was sharing with my members those articles showing the new Porsche and the new Aston Martin electric cars that are competing at that against the Tesla model there. Boy, are there some really sexy electric cars out there now?
Yeah, and forget about the sexy electric cars. What about the $920 million bond payment that he's got to make next week or whatever it is?
Hey, you know what? You can always roll that shit.
And I just think it's, anyways, I know, let's, the Teslonians are going to be very mad at us for suggesting that Elon doesn't walk on water. But
no, we're going to get, our inbox is going to be inundated with hate mail. We'll see how that works out. Yeah. So number 3, we talked about Davos just right now in this clip. Number 2, the blackout period. I want to touch it. Let's just touch on this because we're going to talk about the Fed coming up on the 30th. So we'll save that. But just number 1, ECB and the BOJ meetings. Do you have anything to comment there?
Well, Mario was super, dovish. Like, that's the end of the
crazy. He was super dovish. And you know what? I mean, look, the German yield is like near 0 again. and so is the Bank of Japan. Like the 10 years on both, like we're 19 basis points. I think we closed on the week on the German.
Yeah, 19.3. Like that's insane.
Yeah, and
Like,
the BOJ, it was negative, wasn't it? Or this week?
Well,
the 10-year Bank of Japan.
Well, that one they
or
pegged,
sorry,
though,
government
like,
Japan.
Let me just have a look here. Let's see where that one closed. Yeah, it closed at negative 1 basis point, basically.
Yeah. Like I mean, that's dovish. That's dovish. They're not shutting the printing press off. You know what? I reminds me of that Russell Napier interview we just had this week on Macro Voices, and I mean, he was kind of really emphasizing that the Bank of Japan is messed. You know what? Listen, I'm not going to go into detail. Listen to the Macro Voices podcast and listen to that Russell Napier interview. Did you enjoy it?
I love Russell. Like, you know what? I don't always agree with everything he says. First of all, whatever you have an English or Scottish accent, you always sound smarter. Like that's just the way it is. But otherwise, he's a very smart man. He's very articulate. It was a terrific interview, and he always gives you something to think about. And for me, I'll tell you the part that I love that I came out with was when he said the Chinese currency devaluation will unleash a wave of deflation on the world that will then be followed by decades of inflation. And I thought that was the most important part, and I completely agree with him. We don't have time to go into it with the top 5 things here, but I really think that was a very profound comment, and I agree with him. And I think if you haven't listened to it, go listen to it. It's one of the best interviews in Macro Voices.
It really was a great interview, and I encourage all of our listeners to go and pick that one up. All right, Kev, let's get to it. Let's talk about the top 5 things to watch next week. So for number 5, we're talking about the vol products. So listen, the VXX and the VXZ are notes. And they're maturing. So explain to me what's going on here.
Who'd have thunk it? Like I was kind of, I was surprised. I was like, what? They're going off the board. Basically, these are not ETFs. They are ETNs, which means that they're notes and they have a maturity an end date to them. And that end date is January 30th, 2019. So it's coming up. And there's already a new one in the works. It's VXXB. But I think that everyone should be aware that these things are maturing down into the actual index, and they're not going to be around. So if you own these, which God help you because they just decay to nothing, but maybe if you're short, you're going to get covered.
No, but it's not give me a cash value at the end of the.
For sure, I'm just saying God help you, and that you've been long them for a long time. Like if you actually hold.
Oh yeah, like if you're hoping that one day you're going to be at break even after that bleed.
Yeah.
Shit out of luck, right?
Yeah, so like it's one of the ugliest charts around. But anyways, it's just good for our listeners to know that that's no longer going to be VXX is no longer going to be in existence. VXXB is what you want to be looking at.
So what? I didn't even look. I mean, you think I would have, but I guess they don't have any options that are maturing past that date, or what did they do? Is settle anyway.
They must. Let's just dial it 1 second before I do. Yeah, look, I just pulled it up on the screen. January 25th. It's the last series.
Yeah. So this is something that anyone who's been paying attention has seen coming.
That's right. Obviously not us.
Clearly, it's not us.
In case you're just as clueless as us, there you go. That's number 5.
Well, we didn't manage to make it into the top 5, so we're not that clueless. Number 4, Brazil.
Okay, Brazil. I've been trying to make a habit of going through the charts and looking at the different stock markets throughout the world and actually interest rates and stuff. And I'm not much of a squiggle guy. I love making fun of you guys with your Fibonacci's and stuff like that. But when I looked at this chart and saw what Brazil was doing, all I could think was it was a Hulk smash. Like, it's unbelievable. This thing is nuts. Like, look at what it's done. It's gone from last summer, it was about 7,000, or is that 75,000. It's now almost 100,000.
It's interesting because emerging markets as an aggregate have been getting killed. And fine, you know what? The December sell-off was very much a U.S.-centric event. Because the emerging markets were not where the real selling was. The bloodbath in emerging markets was the entire 2018 year. But what's interesting here is that Brazil, now this is in its domestic currency, is it not? Because if you look at Brazilian index in US dollars, it doesn't look like this.
Yeah, so there is an element of that. It's not quite.
It's not an element. It's a huge element because the real got killed, right? So you're on a dollar denominated basis. This is
well, let me dial it. I don't think it's as bad as you think it is.
Come on.
No, so it's not. It hasn't hit a new high, but it's still breaking out for this.
Yes.
Like, you know.
Oh no, it's bullish. No. Well, I'm not going to try to argue with you, dude. The Brazilian index has by far done better than almost all other emerging markets.
Because don't forget that all summer and fall and early winter, emerging market was going down. And this
in order to make this type of return, you had to be short the real against the long the index, right?
Yeah.
So
Or
you as an international investor, you had to be hedged out of this.
Yeah, you could trade futures as well. Like it's really easy. Like there's no big deal in terms of doing that.
Like if you own the ETF, that's the thing. You didn't get this performance. You're not up 25.
You didn't get quite that much, but it's still done well.
Oh, yes. No. It's definitely up.
Yeah.
And it's been a great place. Like, I mean, they got their own little Donald Trump president going over there in Brazil, and it's been extraordinary on the short term. But I go back and I still think the U.S. dollar global shortages will at some point impact it. I asked the question, I would offer it as a question, what if this is the equivalent of that 2017 into 18 rally that occurred on the reaction of Trump? What if this is the same scenario where there's just that bullish surge because they had a president that is very pro stock market, but once the euro dollar markets and the dollar shortages really kick in, that this is going to mean revert. Right now, it's running hot.
Yeah. So listen, this is a new one for us. The technician is telling me to think about the fundamentals, and the fundamentalist is telling me to look at the technicals. All I know is this thing is running, and I was kind of shocked at it, and it's kind of put it on your radar. It's interesting. It's probably the time I figured out. It's probably time to be going
short. I'm fading this now because of you.
Yeah, I completely understand that, but I think it's interesting nonetheless.
All right, so let's go number 3. And what I wanted to talk about is the dollar index. Let me just pull up the chart over here. So the dollar index, first reaction, obviously, on a euro break on Mario Draghi, was the euro broke down, and we had basically right over here, we had the US dollar rise. And then comes the Wall Street Journal article. And then on the US-centric news, the dollar breaks. Right?
Yeah.
So to me, it's convenient that if I was on, this is the continuous contract, but that happens to be a Fibonacci level, almost like Fibonacci's work, right?
Oh my God.
Is that not interesting? That's a 61.8, my friend. Anyway,
almost to the tick, right?
To the tick. And
it is to the tick.
It is to the tick, and the dollar index reverses off of there. This is something to watch. All of our listeners have to watch this, because is this a key reversal in the dollar? I don't know. I personally remain very bullish the dollar. Russell Napier made a very good argument as to why the dollar is going to go higher, but what's the most immediate short-term path in the coming weeks? Did Powell say in that, or did this Wall Street Journal article that got leaked, was it enough to turn the sentiment on this? What do you think? What's your over-under on this? Where's the dollar going? Listen, obviously you're not a squiggles guy, but what's your intuition?
I think the dollar is headed lower because I think all you guys on the squiggles and even the fundamentalists.
But the squiggles say it's going lower. So
then there you go. So I'm on the squiggles, but
look at them. You rejected the 61.8. So like naturally,
so that's why I have to be short. It rejected the 61.8, so I have to be. I know. To me, I look around and I think there's so many people playing for the dollar breakout, the kind of the deflationary collapse that results from, a tighter Fed and all that stuff. To me, I think that the world is over-owns U.S. assets, and that it wouldn't take much for them just to go back to kind of index weight, which would mean selling of U.S. dollars.
Right. I'm going to take the other side of that, but we'll see.
Okay.
We'll see how that plays out. So number 2, I wanted to mention this. Earnings. Obviously, there's like a golf ball in the garden hose right now. It's kind of a 2-3 week window. We can narrow it down to 1 week, but the behemoths are all reporting next week.
Yeah,
right?
It's a big week.
It's a big week. Apple, Microsoft. Sorry, Monday, Caterpillar. Tuesday, Apple. Wednesday, Microsoft. Thursday, Amazon. Friday, ExxonMobil. I mean, just those 5 stocks alone, you're talking $3 to $4 trillion of market cap, right?
It's huge.
It's huge. And just a gargantuan wave of major earnings. I didn't even mention Facebook or these other ones that are coming, Tesla, all of these that are all coming out. And you know what? It's interesting. There's been some companies that have beat, or at least the market reacted bullishly. But there's your fair share of the Intels where the earnings hand grenade has been pulled, like the pin's been pulled, right?
But you know what's interesting about Intel today is that Intel like shit the bed, but the semiconductors were bought up aggressively.
Yeah.
It's crazy.
But that's because it was an Intel specific story. It wasn't a sector story, right? Like I just think they need a new CEO and shit like this. But the point is, big week in earnings. I'm looking forward to next week's episode so we can actually see what happened here, because I think it'll be really interesting to see how this played out.
I wonder if the new ex-Mrs. Bezos is looking to be interested in how Jeff did with his earnings this month.
Well, certainly her $70 billion stake, right?
Right.
Number 1, Kev.
Like, Jeff, 1 second. She's going to be like, Jeff, you did not perform this quarter.
I'm disappointed in you.
I'm disappointed.
Number 1, Kev.
The FOMC press conference, Wednesday, 2:30. So we get to find out if they were serious about their QT.
So
I don't know how to describe it.
Point, right? This Wall Street Journal article was floated as a feeler, right, to see what the market's response is. The question is, what does Powell actually say? What does the Fed actually say and do on Wednesday? Yeah. I mean, at this stage, how can you not? Is it a pop and drop into the Fed meeting?
I don't know. I don't know why they went out and put out that kind of feeler anyways. Like, of course the market's going to react positively. Do you need someone to tell you that? And like it almost leads me to believe that it just seems so stupid to do that I almost wonder if it wasn't really done. Because, like, why not save it for the actual press conference?
I don't really. I know. I hear you, man.
Yeah, like I'm a little confused by that, and I don't really see. There are times that, like, you're doing Operation Twist, or you're doing this or that, and you're worried about maybe the market won't understand this. Maybe I should check what they're thinking. Maybe I should prepare them for it. But this, to me, just seems like a no-brainer, bullish kind of development. That only a fool realizes that the markets aren't going to take it positively. So why bother sending out this Friday afternoon article unless your only goal is to goose it higher for some particular reason, which I don't really understand why you would want to do that.
Here's my feeling. Whenever something like this happens, what if we see Monday and Tuesday generally be bullish in its trajectory? That really sets up for a prairie dog on Wednesday, doesn't it?
Yeah, that's a noble animal, the prairie dog.
A noble animal. It's from all those peggers out there. That's
right. Just for those who haven't listened before, the prairie dog formation is when a stock or security pokes its head up above and then immediately goes right back into
senses danger and immediately pulls back. Yeah. Anyway, the stock market is very vulnerable for that. Anyway, that's your top 5 things to watch next week. Let's move on. So, Kev, parting words of wisdom for our listeners.
This week it comes from William O'Neill, and I thought this was just a very profound statement. He says, "What seems too high and risky to the majority generally goes higher, and what seems low and cheap generally goes lower." And I couldn't agree with that more. I have a buddy that we have this joke that whenever someone tells me this is a 4 standard deviation move, in the hopes that you're going to fade the move, I always say to them, yeah, well, no, I always kind of laugh and go, you know what the trouble with 4 standard deviation moves are? They often turn into 6 and 7s before they finally turn. No. And I think that's one of the things that you have to remember in markets. They can go way further than you ever imagined.
But Kev, what I would like to contribute to that statement is that think back to what the real art of being a good trader is. And that's losing small and winning big. And to win big, sometimes you have to just let a trade run. You have to allow it to make you big money. And one thing that a lot of people that just haven't been around the block long enough, they see a move and they feel that was enough. And they go and take their profits. And then this extraordinary opportunity to make money happens and they're on the sideline.
Yeah, no, and that's the point, is that it often goes way more than you ever expected. And I always remember Jim Rogers talking about the gold move in the 70s, in the late 70s, or maybe it was 80s, when he said, I was selling my gold, and maybe he was shorting gold, I can't remember, but he says, I was, and this was when gold was $700-800, and he said, I missed the top by $200, which was a lot in terms of, like, think about that, it's 20% or even more than 20% if it's $800. He says, I missed the top by $200. The thing was, I only missed it by 2 days.
Yeah.
And that's what you need to realize.
Parabolic blow-offs are crazy.
That's right. And that's actually what worries me, is that what if we get one of those? And I'm not predicting it. I'm just open to the possibility that with,
thank God you're a trader that's always watching the markets. You'll see it. You'll see it happening at least.
That's right. Anyways.
All right, let's move on. But before we get to the close, I have to ask you, did I wrong you somewhere for you picking on me? I don't remember holding my laptop like this, right? Like, yeah.
We always try to come up with a funny picture, and for those that are listening, it's actually a picture of a fellow being interviewed, and he's got his laptop in front of him, and he's got the computer completely backwards. And I realized that guy's got way too much hair for it to be me, so I had to put a picture. So I said a rare picture of Patrick hard at work taping the market huddle. But the next one will definitely be me.
Oh, okay. Well, you're a gentleman then, Kev.
That's right.
No, okay. Listen, let's wrap things up. Any final words here?
Well, just a big shout out to our sponsor. What a great name, and Flying Monkeys. Big hats off to them, and big hats off to you, Patrick, that you managed to go the whole episode without insulting our sponsor. I'm very proud of you.
You know what? I only had one can from the sponsor, so I switched to this Lunch Money beer that we did a couple episodes back, because the sponsor there filled the fridge with a couple extras. And so Tony was just on fire. Like he how many did he crack open? I heard at least 4 cans crack.
He's our kind of guy.
He's our type of guy. And so I felt compelled to keep up with him. With you, you're soft, right? So like I one beer's enough, but like Tony kept cracking. So I was like, I got to keep up with Tony. And so.
And, I just want to say a big shout out to the listener, and you know who you are, that's kind of reporting back from the Macro Voices conference. Patrick likes to make himself out to be such a Scotch snob and a beer snob, and he's not drinking. And so my spies are telling me you drink some absolute crap in Vancouver. I don't know. What were you drinking?
Listen, you know what? They didn't have much selection at the hotel. We were stayed at the Hyatt, and
but that's never stopped you, right?
No,
That's
like you know what? I'm whatever. I like whatever they had. I didn't recognize half of those West Coast beers, and so I had some like steam whistles and some other kind of East Coast beers that were.
So anyways, the listeners, the Market Huddle listeners, are letting us know that you are nowhere.
Yeah, they called me out. Like, I mean, here I am as a gentleman sharing a beer with our listeners, and they turn around and are like ratting me out. That's
right. Because
cool.
You're nowhere near sophisticated in terms of your beer choices as you make out. That's the end result.
I've been exposed, Kev.
That's right.
I've been exposed.
Okay. Well, anyways, let's wrap up. Thanks for spending some time with us. Please visit our site at markethuddle.com to sign up to receive our weekly email that will include a link to the show and the charts that we discussed. Rest assured, we will never clog your email with junk, and we will only send you a weekly letter and update of our upcoming shows.
All right. Follow us on Twitter at the Market Huddle. As well, you can follow Kevin at Kevin Muir and myself at Patrick Ceresna.
I just want to say, Patrick and I have been tossing around the idea. If you've made it this far, you're obviously somewhat as twisted,
as drunk as us. No.
Yeah. So we were thinking about having a quarterly kind of get together. Well, let's say a Market Huddle listeners. And we're just going to go to a beer, and it's just going to be, we're going to drink some beer and talk about the markets. And if you are interested in that, make sure you send us a note, because we're going to set something up in the coming days. And we just kind of wanted to get a feel for whether this would be something that people would be interested in.
Sounds great. I would looking forward to that. Anyway, listen, thanks everyone for listening. Tony was great, wasn't he?
Yeah, no, Tony was awesome. He's definitely.
You know what? Let's have him back
Canadian.
sometime.
Yeah, we should do that.
Right. Perfect. Listen, thanks for our listeners. Have a great weekend otherwise. And thank you for listening.
Thanks.